Welcome to the Advanced Asset Management Advisors August 2023 Mid-Quarter Market Commentary Update. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Voelker, my business partner and AAMA's Chief Investment Officer. Before we get started, I thought I would give a brief introduction about AAMA. We are an independent and fee-based investment advisor located in Columbus, Ohio. We have approximately $1 billion in assets under management and advisement, and we offer a complete series of risk-based portfolios ranging from aggressive growth to capital preservation or conservative portfolios. The portfolios are based upon the use of mutual funds or exchange-traded funds. And we believe our fundamental market pricing and sector valuation process offers advisors and clients access to our investment discipline, which provides an excellent opportunity to earn returns while controlling volatility within the portfolio. Now, in our most recent commentary, we suggested investors should beware of the headlines. And what about the downgrade of the U.S. banks? Is that something investors should be concerned about or take seriously, or is it just a bunch of more noise coming out?
Morning, Bob. Yeah, so the headlines about credit downgrades in the banking sector is just another piece of negative news. Obviously, we had the bank failures earlier in the year. And as everybody probably knows, we've been underweight financials for some time for a couple of reasons. One, in particular, the negative yield curve that's developed over the last year is not a good environment for banks where they borrow short and lend long, and increasing concerns about potential credit losses. So those issues have not been resolved. As we found out in March, there's roughly $650 billion of unrealized losses in hold-to-maturity portfolios within the banking sector. And there's still $120 billion outstanding in the Federal Reserve's special lending facility, which was designed to tide over the banking system as they work out of those $650 billion of losses. So that $120 billion facility hasn't dropped hardly at all since March. And that's an indication of continued issues in the banking sector. But probably the most interesting, and I at least talked about with this downgrade, is the derivatives market. And the top 25 banks in the United States, this is published quarterly by the OCC, top 25 banks in the United States have 285 trillion with a T of notional amounts of derivative contracts that they're involved with. And you can slice it up however you want. You can slice it into interest rate derivatives, currencies, credit swaps, equity derivatives, however you want to do it. But it's, I think, more interesting to slice it between centrally cleared contracts and private contracts. So centrally cleared, which was originally the intent of Dodd-Frank to make all of them centrally cleared, is only 40% of that notional amount, which means 60% are essentially private or over-the-counter contracts. All of those contracts require collateral be posted by both parties. And while we can't see all of the detail in those contracts, you can imagine that pretty standard piece of those contracts is that collateral needs to be adjusted based upon credit quality of the counterparty. So as credit ratings are dropped, that's going to require more collateral be posted under these over-the-counter derivatives contracts. What that means in general is it will take liquidity out of bank balance sheets, dedicate it to the derivative contract collateral. I don't know that it's going to be big enough to have an impact on the overall system or not, but it will certainly have a negative impact on liquidity levels within the banking system. So, yeah, the downgrades, they make good headlines. They probably scare some investors hearing that things have been downgraded in the banking sector. But there's a lot of moving pieces to look at in the banking sector.
Those are some really interesting comments, and a lot of people don't realize a lot of those details that are hanging out there. I think we've established that the odds of a recession in 2023 are extremely low. And, with strong GDP growth and consumer or continued consumer resilience, but we've also discussed the fact that we're in an earnings recession. And now that we've seen some of the second quarter earnings start to roll in, Phil, can you take a couple minutes and discuss the current landscape and what corporate earnings can tell us about the market?
Sure. Second quarter earnings reports are 95% in the bag. And in general, it's a positive in that the trend of declining earnings has ended, at least for now. We've had 4 quarters of declining trailing 12-month earnings. And I'll just pop up a little chart here. The green line are those that have been already posted as far as trailing 12-month operating earnings. And the gray line is the forecast. So you can see we had a slight turn up this quarter. And golly, that gray line is projected to go on to new highs next year. So you're right. The potential recession this year better get started real quick if we're going to have one for 2 quarters. We're already midway through this quarter with Atlanta GDP now showing a 6% GDP number for the year or for the quarter, which is huge. That'll be revised, I'm sure. But anyway, yeah, the lack of recession, some easing in profit margin pressure has helped the operating earnings turn the tide so far. The caveats to that story are that all of the earnings estimates for what's been posted this year and through the rest of the year have all been revised lower by 10 to 15% since the first of the year. So it gives you an idea of how dramatically those can change over just a 6-month period. I'm not saying that the rest of the year is going to be revised down by 15%, but it's already down by 15% in 6 months. It could go lower. So I would say cautiously optimistic about earnings starting to turn, and still a few question marks out there as far as when is operating leverage going to improve, probably along with the earnings late this year into next year.
Those are all interesting comments. Speaking of fundamentals, this might be a good place to discuss our portfolios. And it might surprise some listeners to hear that we really haven't made a substantial allocation change since just before COVID, but there's a good reason for that. And Phil, can you take some time and discuss why we haven't made adjustments amid all the volatility and why our convictions remain basically where they were in 2019 and early 2020?
Sure. We've made some adjustments in some holdings, not dramatically. And as Bob, as you pointed out, we've not made a major change in our sector allocations since right before the pandemic. And taking us back to December of 19, the market was overvalued fairly significantly. And just about every sector was above median. If it was not overvalued. It had questionable earnings outlooks. So as we approached the first of 2020, we saw a lot of risk in the market. Obviously, we didn't know what was coming down the road with COVID, but a lot of risk in the market. So the structure of our portfolios, and this had developed gradually over the 12 months of 2019, was to not include any significant sector allocations, but to upgrade the quality of the portfolio. And I'll give you some statistics here in a minute, but continuing through 20, 21, 22, we had periods again of overvaluation at the beginning of 22, compounded with the increasing interest rates. So the risk in the market was again pretty high. And again, we had most sectors overvalued. So the opportunity to take advantage of really cheap sectors wasn't there. In fact, if you look at consumer staples and utilities, for example, that are typically defensive sectors, they were in the 85th percentile of their valuations. So they were just as overvalued, or if not more so, than the market. So, those had developed overvaluation levels because of the repressed interest rates. People were buying those stocks for the dividend yield. But I digress. So our approach to the portfolios beginning or developing through 19 and then holding since then has been a quality allocation. So within each sector, we screen a database of roughly 700 companies that are 7 billion in market cap and higher. And the portfolios have been, with the quality screens we use, a couple examples. Debt to EBITDA in our portfolio, our core growth fund portfolio, 2.1 times versus the universe at 3.8. So roughly half of the universe level of debt to EBITDA. Forward PE, we're at 85% of the universe. Return on equity, slightly higher than the universe. Price to sales, roughly half of what the universe average is. Trailing PE, again, about 60% of the universe. So, and still having good earnings growth over the 3 and 5 year period. So it's been a quality in large cap positioning. And it's all in response to the overvalued level of the market. Somebody might ask the question, well, what happened last fall when the market was down 25% at the lows? What happened to valuations then? Well, a lot of the sectors in the market in general pulled back to just above median valuations, but they did it pretty much uniformly across the board. So it did not, again, prompt any changes in our allocations, but emphasize the fact that a diversified sector portfolio, but with a quality screens that we use, was still the place to be. And now we're overvalued again in the market, and most of the sectors are overvalued. The one that I'll point out that's been consistently more attractive has been healthcare. That has not been as overvalued as the market in any of this period that we've discussed, and has always maintained a double-digit earnings growth forecast through that whole period. So that's been a consistent overweighting for us, contrary to the underweighting in financials. So I hope that helps put things into perspective and how we've been looking at things and why we have not made any major changes in allocations within the portfolios.
Thanks, Phil. I think that was a great description. And, as most of our advisors and clients that work with us have already seen, that we're not hyperactive in terms of our allocations and reallocations. But thanks for covering all those items today. As always, our senior investment staff is available to discuss the markets and how our portfolios may be beneficial to you and your clients' investment portfolios. I'd like to thank everyone today for joining us, and please feel free to call me or our national sales manager, Aaron Ploskow. We're always available to answer questions and discuss the markets. Again, thanks a lot.